All right, good afternoon, everybody. Uneducated Economist here. I got my good friend George Gammon with us today. Thank you, George, for taking time out of these holiday season to come and talk with the Uneducated Economist. I'm really excited to have you on the show today.
Well, I appreciate you having me. It's always fun to talk. And Merry Christmas to you, your family, and all your viewers.
Oh, well, Merry Christmas to you the same, man. Thank you very much. For those, I can't imagine anybody not knowing who you are at this point. I
Yeah, of
mean, you
course, of
have
course.
just blown up the macroeconomics, like YouTube. You're on mainstream media now. I see you on Fox News. I mean, holy moly, man, you're killing it out there, dude. I love it. I love seeing that. When I first met you, it was like a few years ago when
Yeah.
you had your YouTube channel. It was, built on a kind of a real estate idea, and you started doing these whiteboard videos. And I thought, man, this dude is good. I gave you a shout out just to say, hey, man, you should go check out George Gammon. He does these great whiteboard videos, much in line with what we're thinking. And you kind of
Oh, I
took me under your
appreciate it.
wing a little bit. You said, hey, man, let me update your channel a little bit and help you out. We kind of been friends ever since. And I really appreciate that, man. Thank you.
Yeah, well, I appreciate the shout out. That was very kind of you. I think at the time you probably had about 5,000 subscribers, and I probably had maybe 200 or something like that. And so it was very nice of you to do that. And yeah, it's been fun to see both the channels grow and to watch you have a very large impact on not only just kind of you always tend to say that you cater to the blue collar kind of average Joe and Jane, and that may be true, but I know so many hedge fund managers and professional money managers that actually watch your channel religiously. So,
Well,
I think that's been fun to see as well.
well, I thank you, Ed. Yeah, I guess they like that alternative view that I might have. So, but that's one of the things that, we kind of find is that, these different views that we have on things, when we compile them together, it gives us the ideas in which that we need to do in order to make the decisions for ourselves. And that's really
Yeah.
what these discussions are all about, is to try and, kind of throw these ideas back and forth to kind of get the different perceptions from the different levels that we're at. And one of those is inflation. Everybody's talking about this inflation thing. And you did a great video the other day talking about what nobody seems to be talking about, and that is the possibility of a deflationary scenario
Yeah.
that could come in. And, I really would like for you to kind of talk a little bit about that, like how everybody was stuck in this inflationary concept, which is very legitimate. I mean, there was,
Yeah.
it was happening.
Yeah.
But a lot of times we kind of lose focus on what could also take place. So maybe kind of like let us know a little bit about inflation and what you're seeing happening.
And also time horizons.
Time
Like,
horizons, exactly.
like if you ask me what the 2020s is going to look like, I would say most likely it's going to be an inflationary decade. Like in the 2050s, we'll look back on the 2020s and say, yeah, that was like the 1970s or the 1940s from a standpoint of we had significant bouts of inflation throughout the entire decade. But that doesn't necessarily mean that that's what we're going to see in 2023. And so, when you zoom in on the next 6 months or the next year, I think it'll most likely be disinflationary. So not necessarily deflation where prices are actually going down, but you have lower price increases. And, but that depends on if we have a soft landing or a hard landing. I think if we have a soft landing, then you will see prices increase at a slower rate, like we said. But if you have a hard landing, I think you actually could see a quarter or maybe more of actually deflation where prices go down. And we saw this during the GFC. If people go back and remember after Lehman Brothers, I can't remember whether the deflationary quarter it must have been in 2009. It's probably like Q1 or Q2 of 2009. If you look at a chart of CPI, you'll see that it actually went negative. And going into the GFC, I'm guessing the CPI was probably hovering around maybe 4-5%, if my memory serves me well. So even to get down to -2, that was a significant decline. But I'd also encourage people to go back and think, why did we see the inflation rate go from 2% or sub 2% to over 9%? And I understand that the CPI, the way it's measured, dramatically understates inflation. But let's just use the CPI as a proxy for whatever inflation is doing instead of an absolute number. So I would argue that it was demand side and it was supply side. So if you look at the demand side, well, we all know what happened there. The government sends out stimulus checks. We get PPP loans. The government says you don't have to pay your mortgage. You don't have to pay your rent. You don't have to pay your student loan. So if you look at your own personal profit and loss, your revenue skyrockets and your expenses plummet. Okay, well, that means you've got a lot more purchasing power. And then on the supply side of the equation, we're saying, okay, we're going to lock everyone in their house. We're not going to let them go to work. And the whole world is going to do this. And then we'll just assume that all the stuff that we've been buying just grows on trees, and we'll have unicorns just deliver it to our house. And then we found out, hey, oh, well, wow, those global supply chains, those actually matter quite a bit. And so you see this double whammy, if you will, kind of these two dynamics at play that creates a perfect storm, where you've got an increase in demand and a significant decrease in supply. And that's where you take inflation, or at least it was measured by the CPI, from sub 2 up to 9% plus, 9%, 9.1 or wherever the high water mark was. So now understanding that that's how we got to where we are. And I know there's limitless variables, but I think those two, we can all agree, are probably had the biggest impact. You say, what's happening to the supply side of the equation right now? Okay, well, it's definitely not as good as we didn't go back to the way it was in 2019. We're obviously not there yet, especially what's going on with these crazy sanctions against Russia, and that's created even further disruptions. But we're not at the same level of supply chain disruption as we were in the middle of the pandemic, when everyone was locked in a cage. So that you could say it's not great, definitely not back up to 100%, but it has improved, let's just say slightly. So now we look at the demand side of the equation. All right, there's no more stimmy checks, there's no more PPP. If you look at the average checking account balance for Americans in aggregate total, I actually had this chart, I think it was from JP Morgan, and they broke it down by income bracket. I think there are 5 income brackets. Now, unfortunately, this data was going back like a year, so you had to kind of just guess as to how fast people were spending down their accumulated savings as measured by the increase to their checking account balance. But back then, even the lowest checking account balance, as far as the income group that had the least increase in their checking account balance, was still like 25% higher than it was in 2019. And I think it went up to maybe like 50%. So with those 5 income brackets, the least increase that you had in the average checking account balance from 2019 was 25%. And this was, say, a year, 9 months ago. And they projected that accumulated savings would not draw down back to where it was. In other words, the checking account balances wouldn't go back down to where they were in 2019 until like Q1 or so of 2023. So then you've got to think, okay, well, if they've got this additional purchasing power because they've got more money in their bank account, it's a pretty direct relationship. Then you say, what happens when they're drawing this down? Okay, they're drawing this down because they're spending more money. They're going to restaurants more. They're spending more on discretionary. And I would argue that that's been coming to a very quick halt. I mean, that's been running into a brick wall if you look at the data. But then you also say, okay, well, they could be drawing down that money, not just because they're out just spending frivolously, but also because we've had negative real wage growth. So it is true that nominal wages have gone up significantly since 2020, but they haven't kept pace with the rate of inflation. So that means that as far as the purchasing power from your paycheck, if you look at that today compared to 2019, your paycheck might be more as far as the nominal number, but you can buy a hell of a lot less with that paycheck, which would lead me to believe that that's another reason why that checking account balance is coming down and down and down and down and down. Now, the problem with that is once the checking account balance gets down to where it was in 2019, we still have the problem of negative real wage growth, which means that checking account balance will probably go down even further until it goes negative. So if you're just looking at that demand side, you can see how the dynamics that led to where we were when we got up to 9.1% are reversing and reversing to a significant degree. Another thing that a lot of people look at, I think rightfully so, would be the increase in M2 money supply. And I'm sure you've done countless videos on this, but if you go back to 2020, I mean, M2 increased by what, 25%, maybe even more than 25%. So obviously this in and of itself might not create inflation, although it's definitely a tailwind. It's something that we've got to say impacted the inflation rate that we did see to a significant degree. So now you look at M2 money supply, and if your viewers pull up a Fred chart, they'll see that it's actually plateaued and now it's starting to come back down. So if the argument was a substantial increase in M2 led to inflation, well, that you've got to argue that a significant decrease in M2 is most likely going to lead to disinflation, if not deflation, especially when you look at asset prices. So I'm not here to say that M2 can't go back up. I'm not here to say that the government won't send out more stimulus checks, which will increase the checking account balances even further. I'm saying that if we continue on the trend that we're on right now, this is where we're headed until the government intervenes and does something stupid again to create a misbalance between that supply demand dynamic. And I think that the probability of that is actually pretty high, but maybe not in the next 6 months. In fact, I just did a story today on how 63% of Americans actually favor stimulus checks to combat inflation. And most of your viewers know, because they're relatively sophisticated that watch your channel, that the way you solve a problem of inflation is by decreasing demand and increasing supply. So if what we're doing to fight inflation is actually increase demand, then we can't expect inflation to come down significantly. So it's all kind of a timing mechanism, you know? It's all like, how long do we continue on this trajectory, which I would argue is disinflationary for the reasons I just mentioned. And then how long will the government go until they come in with their next round of stimulus that will increase that demand side, or maybe do another, who knows what they'll do to the economy to distort it to a level where we see another significant decrease in supply.
Yeah, no, that was great. I mean, that was a great description of what's going on with the inflation, with how it is that people are perceiving this, because I think a lot of it is also like inflation expectation. And when you have an inflation expectation that has been bombarded into you, you start behaving in ways that creates the inflation that takes place. So something very similar can happen on the opposite end of that. If you feel that there's a deflationary scenario, or you feel that things are going to start slowing down, you start behaving in ways that does cause the economy to slow down on top of it as well. And I think that's like not necessarily something that is like easily to gauge, right? Because it's just really, it's just the people's, perceptions and what is happening out there. And
Yeah, there's
when
so
you
many
have,
variables to that as well.
right, exactly. And this is kind of one of the things that I feel is that because it is such a confusing topic to understand, like how, like even just the Fed's balance sheet and how the unwinding of the balance sheet starts pulling in the liabilities back in, that's a tightening, like it's a contraction of the money supply, or can be. you know, that little concept right inside of that is very difficult for a lot of people to wrap their heads around. And so when you come off of this heavy inflationary scenario, and then all of a sudden you have this shifting by the Federal Reserve where they start going into a monetary tightening, a lot of people are still stuck in the inflationary concept and not realizing that things are going to slow down dramatically coming into the future due to the higher interest rates or just the slowing down of the economy in general.
Yeah, and you have recency bias there as well. And another thing that makes it even more complex is it's not just about M2 money supply. And this is something I've been thinking about a lot lately. And it's, you know, even I was under the impression that, well, if you increase M2, then you're most likely going to have inflation. But when I've done a lot of research on this over the last 2 or 3 weeks, and I'm happy to share the numbers with you. So I think you may find it interesting as well. But the increase in M2 isn't really what matters. What matters that definitely impacts it, but it's not what matters the most, I should say. What matters the most is the increase in M2, or the amount of M2, even if it's staying at a static rate, relative to real GDP.
Okay.
So as an example, I looked at data from like 30-year segments. And the first 30-year segment I looked at was roughly 1990 to 2020. And you saw that the M2 money supply increased by 400% during that time frame. So most people would say, oh my gosh, 400%, that's outrageous. That's going to create massive amounts of consumer price inflation. And to a certain degree, they were correct, because if you look at the CPI, it was up over that 30-year span of maybe 100%, 117%, something like that. I don't have the chart in front of me, but these are rough numbers that help you understand the concept. And then when you look at nominal GDP, it was somewhere in the neighborhood of maybe 300%, something like that. So if you just look at that chart, you could conclude that, well, M2 goes up, so does CPI. So ideally, if we could just fix the rate of M2, or make sure that it only goes up by like 2% per year, then we would inevitably solve the inflation problem, which as you know, and as you articulate well on your channel, is hugely detrimental and disproportionately detrimental to the poor and middle class. But then you go back and take that 30-year time segment, and instead of looking at 1990 to 2020, you look at 1870 to 1900, roughly. And you see that the money supply, as measured by M2, during that time frame went up by 400%. Exact same number. And so you could say, well, then, George, obviously the inflation rate must have been near 100, or, you know, right around where it was from 1990 to 2020. No, the inflation rate was negative 45%. So from 1870, and I'm using is like 1867 to 1899, something like that. Well, let's just say from 1870 to 1900, we had an increase of M2 by 400%, the exact same as 90 to 2020. But instead of having 100% roughly inflation, we had 45% deflation. And the kicker there is, with this 45% deflation, we had about 100% nominal GDP growth. So when you actually do the math and you adjust for the 45% deflation, we had about 300% real GDP growth during that time frame, with an increase of M2 at about 400%, right? So then when you do that same math to try to figure out what real GDP growth was during that latter time frame, you see that real GDP growth was only, I think it was, right off the top of my head, like 94%. So that's when, and you look at different time segments, right, throughout the economic history or monetary history of the United States, and you see that there's a direct relationship, not necessarily to M2 and consumer price inflation, but M2 and the delta between M2 and real GDP. That's your big problem. So then you say, okay, well, what is the most significant factor when it comes to real GDP? And in all the research I've done over the last 3 or 4 weeks, it's pretty clear that I believe the main driver, and if it's not the main driver, it's definitely one of the main drivers, is government spending as a percentage of GDP. Right. So what is also fascinating is if you go back to that time frame when real GDP growth was 300%, the government spending as a percentage of GDP was under 10. It was about like 7-8%, something like that, right? Where if you go to that latter time frame, it was 45% roughly. So as as government spending goes up as a percentage of GDP, usually real GDP goes down. And when real GDP goes down, but yet you have a similar increase in M2, you're going to have inflation vastly exceed a time frame when there was far less government spending and therefore far more real GDP growth. And this correlation is consistent whether you look at 1870 to 1990, whether you look at 1930 to 1960, 1960 to 1990, 1990 to 2020. It's the relationship stays very, very similar to that. So your viewers may say, okay, George, I get it. What's the point? How does that help me decide what may happen in 2023? Well, this is just another variable that I think we've got to pay attention to. And this variable is what's going to happen in the next recession to government spending as a percentage of GDP. And I would argue that it's going to skyrocket. If history is any teacher, going back to the GFC or going back to the 2020, we saw that government spending just goes parabolic. And so I think this would also make me argue, as far as my base case, for the next 6 months or so, we get this disinflation, right? Potentially deflation, depending on how bad the recession is or whether we get a soft landing, hard landing. But then what the government does most likely increases that government spending, whether it's stimmies or whatever we see, which will distort the economy. This distortion of the economy creates less economic output, which by definition is going to create lower real GDP. So then when you have the same increase in M2 money supply, regardless of whether that's happening as a result of the Fed buying bonds from the private sector, or any bank buying bonds from the private sector, which would increase M2, or bank lending just goes through the roof, credit creation, because the Fed's backstopping their balance sheet, and therefore we get that increase in M2, or maybe it's direct stimmy payments. But then you're going to see that M2 going up and that real GDP going down. I think that's, if history is a teacher, that's going to really put upward pressure on the CPI, which could take us into that next wave of CPI growth, just like we saw in the 1940s, just like we saw in the 1970s. Inflation never goes up in a straight line. I mean, another statistic I'll give your viewers is in 1947, the CPI got to 19%, 19%. And no more than 2 years later, the CPI was at negative 2%. So we went from 19% inflation all the way down to 2% deflation within the matter of about 2 years. And even in the 70s, in 76, as an example, I've seen several debates between Milton Friedman and other prominent economists of the day, where they thought inflation was done in 76 because, it went up and then they had that recession like 74, 75. And then the inflation rate went from like, let's say 10 or 11, all the way down to maybe like 5, 4, something like that. And so a lot of the economists were saying, oh, yep, we're done. Woo, good jobs, Arthur Burns. You solved inflation. Good job, buddy. And then Milton Friedman was out saying, no. This is not the end of inflation. This is just the beginning. And they would debate back and forth. And sure enough, as we know, Milton Friedman was on the right side of history. But my point is, even in the 1970s, we think of that as an inflationary decade, but that had little spikes of inflation, and then it had valleys of disinflation. Now, we never got deflation in the 1970s, but we did get that in the 1940s. And I think most people, if you just look at a chart, you would easily come to the conclusion that 1940s in aggregate total was definitely an inflationary decade.
Right. No, that's incredible to think about. So, like, when we think about like maybe our timeline, because a lot of our viewers, like, that might have been really confusing for them to try and follow all that stuff. But if we just kind of break it down very simply, like if we follow this inflationary scenario that you might be predicting coming into the future, is that we're going to have what may resemble a disinflation or an easing in the inflationary pressures, which a lot of people are going to get confused by, thinking that the problem is over.
Yeah.
And at that point, we're actually going to see a reversal in that inflationary problems, like people's paychecks not going as far, like the consumer price index not, like not going down, but continue to go up. That's going to continue to put pressure on the Federal Reserve to maintain the higher interest rates for longer, isn't it? Is it not? I mean, what do you think the Federal Reserve's reaction to this is going to be?
I think they pause, and then I think they pivot. And then once they pivot, that this is a result of inflation coming down due to a recession, maybe soft landing, maybe hard landing. And then when inflation comes back down closer to their 2% target, then they're much more likely to say, okay, inflation is something of the past. We beat it. Now this gives us cover to go ahead and do the next round of stimulus, or the next, CARES Act 2.0. And instead of being 5 trillion, this time it needs to be 8 trillion, because of the monetary heroin that we all talk about, that, if you give the government, or if you give the economy that's addicted to the drug this much of the drug, well, next time you got to give it more and more and more and more, just to have the exact same effect. Now, the problem with that is that even if that doesn't increase M2 money supply, so let's just assume for a moment that the Fed was out of the picture.
Okay.
So the government is going to deficit spend to the tune of $5 trillion. Okay, well, they're going to have to pay for a lot of that spending. They're going to have to tax it. And then the deficit would have to come from issuing bonds. All right, people say, well, George, there's no demand at the long end of the curve, for the 10-year and the 30-year. And I would say, yeah, you're right. There's definitely a decline in demand, although we still see private foreigners buying a lot of the 10-year and 30-year treasury, but they got plenty of demand at the front end. Plenty of demand. I mean, if you look at the 1-month treasury right now, it's trading at like 50 or 60 basis points under reverse repo. So this is telling us that you could throw in, and I'm not saying, I'm no fan of government spending, trust me, as I just pointed out through that long lesson in history and M2 and real GDP growth. But I do think that the market would easily absorb another, who knows how many trillions of dollars worth of bonds, as long as they were issued at the front end of the curve, right?
So basically issuing out some short maturities, like probably like what, less than 5-year kind of thing, or?
Oh, no, T-bills.
Even shorter than
T-bills.
T-bills all the way down to a few months. Yeah.
Yeah. So 1 month, 3 months, 6 months, all of those short-term maturities. I think that's because, see, the market uses those as collateral. So they're not really buying, a 10-year, they're going to buy it to either get a capital gain from interest rates going down, or they're going to use it to hedge their balance sheet. A lot of these money managers, or, just an average investor is going to buy it to just collect the yield or whatever. But then you've got the delta between the yield and the rate of inflation, assuming your expenses are in dollars. But it's much more of an investor dynamic at the long end of the curve, where the front end of the curve, most of that demand is just really coming from the need for collateral in the global monetary system. So two completely separate entities. And what you can say, I mean, it's shocking with the government having, I don't know, what 30 trillion in debt or something, that there's actually significant demand for even more debt, at least from the global monetary system.
Hmm.
So I think that gives, along with the inflation rate likely coming down due to a recession, especially if we have a hard landing. I'm just saying that that gives the government cover to go ahead and do another stimulus package, or maybe UBI. I think that's something that we could be seeing. I think it kind of, we get another round of stimulus, and especially if that next round of stimulus doesn't create significant consumer price inflation, then all of a sudden, oh, that's something that was just a result of the pandemic. We never have to worry about inflation again. So let's just go ahead and keep deficit spending. And then that deficit spending, even if it doesn't substantially increase M2. So again, let's say the Fed's out of the picture and the government is just issuing bonds. So they're taking money out of the economy, money that already exists, and then they're just spending it right back into the economy. So on net balance, the supply of currency units chasing goods and services does not increase, right? And same thing with taxes. Taxes, they're just taking money out, putting money right back in. It doesn't have a big difference on the actual level or the number of currency units in the real economy. So let's just assume they're doing this for a moment, right? So you'd say, well, George, that might not be inflationary because they're not significantly increasing M2. But then I'd go back to those data points that we were discussing earlier, and I'd say, yes, you're right. It might not increase M2, but it most likely will significantly decrease, especially over the next 2 or 3 years, real GDP. And this is the key, and this is kind of the blind spot for a lot of people, where they wouldn't recognize that if real GDP goes down significantly, then you're most likely going to have an inflationary backdrop or an inflationary type of environment, right? And the further that real GDP goes down, meaning the more government spending you have as a percentage of GDP, you're basically squeezing out the private sector, is basically what's happening. And the private sector is what's creating goods and services. I think that's why you see that dynamic at play. So the government just goes from 45% up to, let's say, 60%, up to 65%, and then they're spending money inefficiently, and therefore that would lend itself to the next few years going right back to that inflationary mode. And then then it just kind of happens in cycles, and then the next thing you know, we're sitting in 2030, and we look back on the 2020s and we say, yeah, at times the inflationists were dunking on the deflationists, and then at other times the inflationists were dunking on the deflationists. It just goes back and forth and back and forth. But I think the prudent investor will realize that you can have these environments at different times throughout the entire decade.
That's exactly right. Something that we kind of talk about, and we are pretty much assuming, but we pretty much know as well, is that there is going to be some sort of effort coming from, whether it's the banking industry and the Federal Reserve with government, but at some point there's going to be an issue and stimulus is going to have to be made, right? There's going to be, the government's going to intervene somehow, and they're going to do some sort of money injection. Now, back during the great financial crisis, we had this systemic problem with the mortgage markets and the toxic securities and stuff like that started bringing down the financial market. And then just recently, we had the pandemic, which locked everything down, which I think was more of an excuse than it was a reason. But what do you think is going to be the excuse on the next one that comes up? What is going to be their ultimate reason for being able to stimulate? Because if you don't have a systemic failing companies like the big banking system, or you don't have a pandemic, what excuse can they use, or what do you think they're going to use?
Well, ironically, it could be inflation. I mean, again, in a disinflationary environment, it doesn't mean that we're deflation. That can be inflation going from 7% down to 5%. But that's still an increase of prices year over year by 5%. That's still very, very significant. So I think, and I don't know if I finished telling, anyway, I was doing a story today on the American view, the average American view towards stimulus checks.
Oh, okay.
And forgive me if I'm repeating myself here, but the study showed that 63% of Americans favor stimulus checks to combat inflation.
Yeah, and now that's really interesting to think about, because that's really like throwing gasoline on the fire.
Oh, absolutely it is, because Yeah, like we all know that in order to fight inflation, you've got to decrease demand, increase supply. So what they're doing to fight inflation is just increasing demand, which will just,
Right.
to your point, just exacerbate the problem and then just make it worse. And then who knows, then they could even use that as an excuse to say, oh well, those greedy capitalists
Right.
raised prices, so we just need to do more stimulus checks, to help cushion the blow of consumer price inflation. This is what the politicians are telling us. So my point there is we might not have UBI thrust upon us. It might be a bottoms up type thing where unfortunately the people just can't connect the dots and they demand stimulus. The government doesn't just say, here, this is what you're doing.
Right. And that's one of the scenarios that I think is going to come down, is going to be something to do with food supply. It's going to be a hunger thing. And when people are hungry and the government says, here's your solution to get you something to eat.
Yeah, free money, quote unquote.
Free money. Yeah. I mean, they'll take it. They won't even hesitate. They'll be like, where do I sign up? Show me. Where do I get the tattoo? How do I get the injection? Whatever it takes, just give it to me. And, especially when it comes to something like food, there's going to be like almost no argument to it at all.
Yeah. And I think they'll do price controls too, Simon. I think they'll like, if we go into another wave of inflation, like we're talking about like a year from now or so, I think my base case is they bring out the new round of stimulus, which basically turns into universal basic income. And they do that through like a central bank digital currency. So, to your point, the Federal Reserve or the politicians say, hey, in order to get your $1,000 a month in your freedom dividend, or whatever Andrew Yang wants to call it, you just go ahead and download the Fed app on your phone. That's all you have to do. And so everyone's like, yeah, let's download the Fed app. And then that gives you an account at the Fed. Just like right now, you've got an account at B of A or Wells Fargo or Chase or whatever. So now all of a sudden, the Fed can create these bank reserves out of thin air, which is really the quote unquote money printing. Most people say, oh, the Fed prints money. And you and I both say that, and we use that term too generically. And I'm more guilty of that than anybody. But at the end of the day, the Fed really doesn't print money. They just print bank reserves. Especially so if your definition of money is M2, then the Fed doesn't completely control that. And they might not even, it might just be a drop in the bucket, let's say. But anyway, the main point there is this would give the Fed the ability to directly impact M2 money supply to a significant degree. Because now all of a sudden they are able to quote unquote print money in the sense that those bank reserves can be used as legal tender in the United States to buy goods and services. And currently the liabilities on the Fed's balance sheet cannot do that, or they have to have that intermediary of the commercial banking system.
Yeah, and that's the other that's the other thing that I feel is going to have to cause, like, there's going to be almost some sort of crisis scenario taking place in order for them to restructure this banking system to accommodate the central bank digital currencies. Like, I mean, I don't know, maybe I got this wrong, but to me, like, the direct injection of central bank digital currency from the Federal Reserve into the monetary, like into our hands, essentially, isn't exactly legal through their charter. Like, they have to route it through the commercial, but the central bank digital currencies could really, like, if they were to introduced into our system, could be given that permission almost, like that circumventing,
You're absolutely right that would be completely antithetical to the Federal Reserve Act. But I just assume that they're going to ignore it because that's exactly what they did during the pandemic. They set up those special purpose vehicles to buy corporate debt. That they can't do that, but they did it anyway, and no one called them out on it. Nobody, except for Barnes and me with what we're doing with that FOIA request. But other than that, I didn't see anybody really calling them out on it. So I think to your point, I think what would most likely happen, kind of my base case, I think we'll definitely see a central bank digital currency. It's really a matter of when. And I think if if we don't have a hard landing and we have this soft landing, I think you're looking at 3 years, 5 years down the line where you get this central bank digital currency. But I think we have a hard landing and they really want to inject we'll call it the liquidity or the money directly into the system. And the Fed doesn't want to go through the commercial banks. I think that they'll probably figure out a way to circumnavigate the Federal Reserve Act in order to get that done. So now how they do that, who knows? They'll set up another special purpose vehicle that will be a liaison, let's say, between the Federal Reserve and the people who are receiving the stimulus on their phone. But at the end of the day, it'll still be a liability of the Fed that will be spent into the economy as legal tender. Effectively it'll be the same, but there might be a middleman in there just so they can say, no, we're abiding by the law.
Right.
Arm length. It's going to be the same arm length distance as it was between FTX and Alameda. It's like, yeah, sure. Completely separate companies. Yeah, right.
Yeah. What do you, I mean, obviously nobody can tell the future on what's going to happen off of this, but if you were just to kind of give it a guess on what would happen with precious metals and gold, if there was an introduction of central bank digital currencies, what do you think those two things are going to, what do you think is going to happen with precious metals? It's a tough one.
Yeah, I'm not sure how that would, if we have, because see, I don't even know that if people can't connect the dots between stimulus checks and inflation, I don't know that they'll connect the dots between a central bank digital currency and the need to hold purchasing power outside of the financial system, i.e. gold, silver, Bitcoin, something like that. I think what may have a bigger impact is if they ban cash. Because if they move to a central bank digital currency, in order to maximize on the effectiveness for the central planners and the authoritarians, they would also need to ban cash. And that's why, when people ask me, what can we do to push back against this stuff? I say, just don't let them ban cash. Most people don't understand why that's so important. But and the reason is because it just gives you some form of purchasing power outside of their control, outside of the system. So, and why is central bank digital currency such a big deal? Well, one of the main reasons, because a lot of people say, especially the average Joe and Jane, well, who cares? Because I don't use cash anymore. All dollars are digital. So we already have a digital currency. It's called the dollar. So who cares if it's a Fed coin or what it's called? It's still the exact same thing. But what they don't realize is that the electronic digits you have in your checking deposit account right now, those are not programmable. Once you start getting Fed coins on your Fed app, those are going to be programmable. So what that means is if, let's say, you're in Portland, Oregon, where I grew up, or close to Portland, where I grew up, and I know that is a mecca for 7.3 power strokes. So this is a model of Ford engine that they had between 1994 and a half and 2002 and a half. And it was actually made by International, but it's called a 7.3 power stroke. And there's a diesel engine they put in a lot of their pickups, which is incredibly desirable. It's one of the best engines ever made. And why? Because it'll go 1 million miles before the thing's even broken in. I'm exaggerating a little bit, but the thing's just, it's bulletproof. It's a bulletproof motor. And that's why it's still in such high demand. Okay, fine. But it gets 10 miles to the gallon, and that's diesel. So say that you live up in Portland and you love your 1997 crew cab 7.3 diesel. But you've got all these Fed coins and that are programmable. And not only that, but every single purchase you make is going directly to the Fed. So they can monitor all of your transactions. So they can give you a carbon score. Let's just assume for a moment, where they say, okay, Simon, you've bought 50 gallons worth of diesel this month. We can see that. So this means that we allot you, let's say 100 carbon points per month. So this takes you down to 50 carbon points. And let's just assume that you went out and you had a family dinner or something like that. So you bought a bunch of steak and some hamburgers for the kids. And we all know that cows completely destroy the environment. So that will bring your carbon score down to, let's say, 10 points. Well, now all of a sudden it's the 21st of the month. You got to get to work and you got to fill up your truck with diesel, but you don't have enough carbon points. So what happens is when you take your Fed app to the gas station and you swipe it to fill up your truck, although you have dollars in that account, they're programmable, and the Fed programs it to where you cannot use those dollars to purchase the gas because it'll take you over your allotted carbon credits for the month. And this is just one little small example as to why there's such a huge difference between the digital dollars you have in your checking account right now and the digital dollars that you would have on your Fed app if we go to a central bank digital currency.
Yeah. And it's, I mean, when you think about the central bank digital currencies and the elimination of cash, and you let your mind spin on some of the power trips that these guys could go on with that. I mean, there's some ideas that can really be sold on the whole central bank digital currency, like just not trying to be a defender of it, but just, player of the devil's advocate on it. But like, say, for example, there was a stimulus that needed to be put out there.
Yep.
Well, you have some people out there who aren't going to put their stimulus into the economy. They're going to go and invest it like a smart individual should do, right? But they really want people to go out there and spend the money. So you could force that to take place. Like this central bank digital currency stimulus that came to you can't be used for drugs, alcohol, investments. It has to be used on provisions, necessities, power, or stuff like that.
Or you couldn't take it outside the country.
Yeah, I can't take it out. And then you can also put a time limit on it. If you don't spend it in the next 30 days, you lose it. So it can force that stimulus out there and force people to start spending it. I mean, it can really, you think about it, it's like a central banker's wet dream to have something like this.
And they can individualize monetary policy based on narrative and not merit. So as an example, Simon, you've eaten a lot of beef this year. You obviously have a diesel truck. We don't like that. So when you go to apply for your next home loan, because you've damaged the economy so much, we're going to give you a 10% interest rate, where if you would have just driven a Tesla and eaten bugs, then we would have given you a 5% interest rate, something like that.
Right. So it's doing the social score just by your natural behavior throughout your life for the previous years. Now it's come time to make a decision on finances. And they're like, well, because you're kind of a jerk back here, or at least in our opinion, we're not going to give you the availability to excel like everybody else can who did pay attention to what we wanted them to do.
Yeah, because you're being an irresponsible citizen.
Right.
So why should we give you the same interest rate that all the responsible people are getting?
Yeah, exactly. And I mean, at least that idea behind it. But it really, when I think about that, what kind of how un-American, how loss of freedom, how the loss
That's
of
an understatement.
constitutional believing, right? I mean, at least at this point, you can still have some sort of belief that you're free, right? You can hold on to gold and silver and cash and then say, hey, I'm operating outside of the government or whatever. You can at least have this belief that you're doing it. But once it's central bank digital currency, you can't even do that. You can't even imagine yourself being free, at that point.
And so, because where that gets difficult is, I think what they would also do is, in order to get a business license, I see you having to download the Fed software at your point of sale device in order to have access to your account on the Fed's balance sheet, in order to accept Fed coin, which are just denominated in dollars, so dollars, Fed coin, whatever you want to call it. And therefore that would give them the opportunity to monitor both sides of the transactions, and then monitor what was happening on the revenue side for the businesses, and then the expenditure side from the customers as well, right? And then I'd have to think this through, but I would assume there would be a way for them to, well, maybe there wouldn't though, because I was thinking that if they had that software, that would somehow give them a way to monitor each transaction, so they could not settle in gold, or they could not settle in silver. So let's use your lumber store as an example. This is a perfect example. So someone comes in and you're the gentleman who owns your store is like, Simon, I have no choice, but we've got to download the software for our point of sale, our credit card machine or whatever. We have to do it because we have to take Fed coin. It's just what people want to use. So, but then someone comes in and says, listen, Simon, I'm a longtime customer, but I don't like this Fed coin thing. I want to go ahead and settle in silver or settle in gold or something like that for my order of my, all this plywood or whatever. And the owner says, okay, yeah, we can go ahead and do that. That's not a problem. And then, but I don't know how the government could get in between that transaction. And that's a good thing, right? That's a good thing. I'm just trying to think of a way that they could somehow block that, whether it's, reconciliation on the taxes maybe what you'd have to do is you'd have to reconcile your gross sales, but that would just have to be like off. That'd just have to be like under the table, something like that. And unfortunately, this is where this always leads, whether it's with communism in Russia, whether it's, any of these, over the top authoritarian central planning type of systems, they always lead to a black market. Yeah. And if we go down this path, which unfortunately I think there's a high probability that we will, this is what the government is going to force people to do. They're going to force people to transact in the shadows, and otherwise law-abiding citizens, they're going to, force them to do things that might, hopefully won't, but might be actually illegal just to survive, just to get through, just to buy that diesel at the end of the month that you need to get to work when you're over your monthly allowance for your carbon score.
Yeah. I think they can, I think what we're going to see, and I think is probably going to play into a lot of what you're saying right there, is that they're going to tokenize everything. Like every single thing in the entire world will be tokenized, in the sense that that sheet of plywood just simply can't even be purchased without crypto or some sort of digital currency in order to make the purchase, because it's a token. You need to purchase the plywood token in order to get the plywood. And that tokenizing will then be the digital ledgers that move into the central bank digital currencies. So it would be like, and I can almost see this happening like on the fly. Like in order to, buy this chunk of plywood here, you have to buy the company's token. The token can then buy the plywood. Each sheet is tokenized as they're
purchased. It's like Chuck E. Cheese.
Like Chuck E. Cheese, just, you got to get the tokens and play the game.
Yeah.
Same thing. And so with this, then it would be forcing the tracking of each one of those. They would know who got each sheet of plywood within the unit. They would know each lumber yard. They would write down to the customer, because they would know whose digital wallet purchased that particular sheet.
Yeah. And I think that's what they use artificial intelligence for.
Yeah. And with QR codes and artificial intelligence and stuff, the way things are moving, I could really see that happening, where the tokenization of everything happens. We all end up on the digital blockchain technology. Even our individual labor selves, end up doing that.
I think that's a great point. And then your alternative is just within the United States, just to get involved with the community that tries to transact as much as possible outside that system. But I don't think people really realize how difficult that would actually be. Not saying that you can't do it, or that it's not desirable, but that is incredibly difficult. What I've chosen to do in that world, but obviously I've got a lot more flexibility than most people, but is just to try to go to and set up my plan B and C in countries where 99% of the transactions are currently in cash. because
what
although they could implement a central bank digital currency in a Colombia, as an example, where I am right now, to actually do the cash ban and get on that system where everything is tokenized, that would be that it would most likely happen, but your runway is a lot longer in a place where currently such a large percentage of the transactions are settled in cash.
Yeah. You know, and that's another thing that you were saying is like, I don't think, like, people say, well, you can just go back to the barter system. Now, I lived on a hobby farm. I raised chickens and vegetables and stuff like that, and we ate a lot off of our own efforts there, off of the property. But we had to trade for the majority of what we had, and trading meant that you had to know a lot of people in a network in order to trade for the things that you needed.
Yeah.
And it's not just a matter of like, hey, I need, you know, like, you know, there would be people that we knew who had goat's milk, for example, but they didn't always have it. And so like getting it wasn't like just something you could just go to the store and get. So the barter system, although it does work, it is very cumbersome and is not efficient and doesn't provide you with everything you need.
Yeah.
And
And at some point in
unfortunately,
time, you'd have to interact with,
yeah,
like, you know, say you get, heaven forbid, you break your leg or something and you got to go, or just, you know, the other day, my neck was giving me problems. So I had to go get an MRI here, and they found out I've got a herniated disc in there that I've got to do physical therapy for. But you know, I doubt someone on your farm is going to have an MRI machine to.
right.
So, you know, see, what it boils down to is what price are you willing to pay for your freedom? And unfortunately, the government may, at least in the West, the developed world, may put you into a position where the price that you have to pay for your freedom is basically taking your living standards back to what they would have been in like the 1800s.
Man, ain't that the truth? I mean, it really is. If you want your freedom, you got to basically separate yourself from everything that is convenient.
Yeah. And you're just living in an agrarian type of
Yeah.
lifestyle. You're basically living like the Amish.
Yeah. And I mean, what good is that? I mean, how fun is that? Right? You know, I mean, I enjoy sitting down and watching movies and stuff. Like, I want to, like, you know, I enjoy the technologies that we have nowadays. I want to enjoy my surroundings and my life and stuff. So, yeah, trying to move back into the lifestyle of the Amish, it's not a desirable condition for me. I'm not, I mean, I don't want to do that. You know. So, George, thanks for taking the time today, man.
Yeah. Oh my gosh, it's already been an hour, hasn't it? I just looked
It
at the
has.
clock.
It just flew by. I just checked it. I couldn't believe how fast. But
Yeah. Well, thanks for having me on. It's always fun to talk.
yeah, absolutely, man. Was there anything else you wanted to add that you might thought of that, you know, the viewers should really know about? Or I think we covered quite a bit. I mean,
Yeah, I think so. If your viewers would like to check out the data points that I was referencing before,
yeah,
where kind of my hypothesis is the main source of our consistent and persistent inflation since 1940 isn't necessarily an increase in the money supply, but it's more so a increase in government spending as a percentage of GDP. And why that matters is because so many people out there are, you know, sound money, which I think is great, but they see sound money as a panacea. Like, if
right.
only we could fix the money supply, you know, base money, then we would never see inflation. And I just want to say that in my opinion, that's not true. Although it's desirable to have sound money, it doesn't fix all of our problems. So we've got to be just as focused. If we want freedom, liberty, and free market capitalism, we've got to be just as focused, if not more focused, on government spending. And then people say, well, George, well, sound money would prevent governments from running deficits and doing all these things. And there again, and that's you've got to look at the tax revenue. Like, I'll give you a quick example, Simon. When you saw, and I know you know these statistics, when you go back to 1940, pretty much from 1940 to where we are today, we've never really had any significant bouts of deflation. We had one in, I think, 52 or 53, and then one during the GFC, but it was very short-lived. Where if you go back prior to 1940 to, let's say, 1870, it's like a heartbeat. It's just up, down, you know, you have tons and tons and tons of deflationary kind of waves, just bam, 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 bam. And so you say, well, why is this? And I think one of the main reasons is because right during the 1940, World War II is, and then during the Great Depression, when FDR increased government spending substantially, it took it to a level where it was up over 20%. Once you saw government spending as a percentage of GDP over 20%, that's when we really started to see consistent levels of deflation, or of inflation, excuse me. It wasn't necessarily the start of the Fed in 1913. So then the question becomes, okay, George, if this is true, then what would we need to do in order to get government spending to that level? And you see that even in a sound money system, you could get there very easily. Like right now, as an example, state and local is probably 20% of GDP. And state and local doesn't have the quote unquote money printer of the Fed. So they have to use existing M2 money supply, and it's still over 20%. And then if you look at the government tax revenue as a percentage of GDP, that is right around 18%. So I don't know that if we were on like a gold standard, as an example, I don't know that the tax revenue would be less than 18%.
Right.
So my point there is that, yes, sound money is desirable, but we have to get hyper focused on government spending, taxation, deficit spending, reducing regulations, these types of things. And sound money in and of itself, I don't think gets us there. So anyway, the data points in these charts that I would give your viewers, let me get the website here for you. It's all on this website, and this is incredible info. In fact, you're gonna, I'm sure, love this thing. But the website is longtermtrends.net, and that's where you've just got all this data that I was referencing going all the way back to 1870, which I think will just your viewers and maybe you will find incredibly valuable, and maybe help you think about this problem of inflation in a little different way.
Yeah, awesome, George. Thank you so much. And I will definitely grab that link and put it down in the description. I will also put a link to your website, or to your channel website. You got the Rebel Capitalist event coming up as well, don't you? That's
we've got the next live event is May 12th through the 14th in Orlando, Florida.
Man, that's super
you've been a
exciting.
speaker there. So Ron Paul, Jeff Snyder, Brent Johnson, all those guys. So if your viewers want to check that out, they can go to rebelcapitalistlive.com.
Yeah, definitely check out the Rebel Capitalist Live. The event is just incredible. I have never had a place where the energy is to the level of that. I mean, it's positive, it's networking, it's information, it's everything that you could want. And I mean, I can't imagine a better economic convention than the one that you put on. So thank you for doing that for everybody.
Yeah, thank you for plugging it.
Yeah, you bet. All right, George. We'll talk to you later, man.
All right, have a good one.
You too.